Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at HQ is Henry Schwartz. He's a president of TradeTalks and I think the street's resident expert on options volume. And Henry, let's take clues from the options market based on what we saw over the past couple weeks, because it was interesting. Our former colleague at the street, Jared Dillian at the Daily Dirt Nap on Twitter said, is this an overextended bull market or a prolonged bear vol market? You have to look at it kind of in a different context from just equities.
It absolutely is, and I think that everybody. I mean, we were up 7% in January, so for the market to correct 5%, not that big a deal. Like if you look at the the chart for a couple months, you're like, okay, we're back to December, big deal. You just made this money, and as much as it might be unpleasant to kind of give it back, this is not really a panic mode. And in fact, a trader that I've been talking to, even last year, he was like, the way this market's behaving, and this is in December and even January, he's like, that people have upside stops at 1% and downside stops at 10%. Meaning, if the market goes up, 0.75%, 0.9%, all of a sudden everybody's like, I gotta buy some of this, and that you'd have this rush to the upside. On the downside, nobody was even paying much attention. He said, yeah, maybe if we're down 10%, people will start to panic a little bit and puke out. And so that's exactly what all of a sudden, when we really did get what felt like a severe correction, it was a big surprise. People were definitely complacent. I mean, so to look at it and say, okay, was this a correction in terms of equity levels or the end of this bear market and volatility, right? This ultra low implied and realized volatility, which had VIX settling at 9, and I think that's I think it's both really happening at the same time, and that might be what's kind of whacking people is. Volatility was so low that it can only go down so low, right? So everybody knew we were at a lower bound on what was even possible, and yet we stayed there, and so now it's shaken everybody up, and everybody knows it blew out those levered inverse products, and now everybody's kind of stepping back and going, okay, now what's it going to look like in a month or two?
Right.
Is this the end of the harvesting volatility, crowded trade, or is it just kind of, maybe it's a wake-up call, and people that used to hedge their portfolios kind of systematically might start to do that again.
Right. So the question is this another blip on the buy the dip radar, or are there any clues within the options market where you can see, looking a little bit further out, what traders are expecting?
Well, in terms of volatility persisting, if you look at the term structure of almost all of the products. You see, near-term vols in the 20-something% handle, and then, 6-month vol back down into the 15, 16. So, the data is saying it's going to be volatile for a little while, which is what you expect because volatility clusters, right? So, but it does seem like the market at least is thinking things will mellow out over, into the spring and the summer.
Right. Well, there's a lot of events that are coming up, at least for Quad, which was on March 16th. Right, you have the big Fed meeting in between, and as we were discussing earlier, even though the central banks are not selling securities, they're also not buying anything either. So it's just naturally going to dwindle off the balance sheets, and that's really why the question is it different this time? Is it just an equity issue, or is it a bigger systemic issue?
I mean, my gut feeling is that it's a little bit different, although. People that have bought the dips or sold the blips in the volatility space have done so well over the last few years. It's hard for me to think that people aren't going to keep trying to do that. And you're right. It feels like the winds have shifted a little bit. You're just sentiment-wise, you have a lot more coverage of, oh, we have a new Fed governor, and oh, interest rates are really starting to go up now, and all these these headwinds for equities. I think that stuff, there's some truth to it. I think the market was just going up so consistently that everybody was just blind to the whole thing. However, I don't really see that changing the dynamic of the equity markets, and the fact that when volatility spikes, it is a mean reverting behavior, and people that know what they're doing, and I think that's an important distinction now that you're hearing some horror stories out of the levered volatility product space. Those people that know that what they're doing are going to keep doing it. And we crunched the numbers for the last couple of weeks in the options market. volume was insane. We had 4 days over 33 million contracts. Okay, last year the average daily volume was 16 million. So to basically be sticking at double that day after day was an amazing amount of volume.
Right. But now you're seeing it trickle back into what the average was.
Today's the first day that really.
As of what is it? Tuesday, February 13th.
Right. It feels normal. And normal, unfortunately, is kind of quiet, right? When I left the office, the S&Ps were relatively flat. Volatility is kind of hanging in there, which is interesting because I think that people are talking about still more, that there's this liquidation that's kind of trickling out there. You see it in some of these volatility instruments that they're just not quite collapsing back because I think a lot of people are looking at it as like, okay, some guys that used to, sell volatility either directly or indirectly, they're out of business. We know there are some headlines of funds that disappeared. So it may take a little bit longer for things to shake out. But I really hope we don't go back to this really boring, under 1% move day after day after day because that really makes so much. You want the variety, right?
Right, it's untradeable.
Yeah, it's like people don't hedge because the market's not really moving. People don't really sell premium either because premium is so low. It's like it seems to me like we've gotten back to this kind of sweet spot, which is more like volatility's in the mid-teens than in the single digits.
Right. Well, let's wrap it up and take a look at some specific option flow on NDX.
Sure.
Talk about the NDXP as well.
Right. So we looked at the data in the NDX and and the NDXP, which is the weeklies. And what's interesting is the broad indexes, S&P and SPY and Qs. Were incredibly active last week. In fact, as much as volume exploded, it exploded a lot more in the ETFs and the indexes, which is what you expect when people are basically kind of, when correlations are going to 1 and people are somewhat panic hedging. And that's where the liquidity is. It all kind of goes right into that. Looking at the NDX index product, the biggest trade we saw was Friday, and it was a call seller. Okay, so it was a 4,800 put seller. So this is like a 25% out of the money put, and a decent sized trade. I mean, I think it was about $1.4 million in premium, an opening put sell, and that is that's somebody and volatility spiked in Nasdaq as well as in the S&P. It didn't spike to triple what it had been. It was more like up about double, and this looks to me like a trade where somebody just saying, what. This is an opportunity. Volatility, when volatility spikes up, and if traders who know what they're doing, they have the capital, they have the risk management tools, that's a really attractive sale. I mean, the guy, it's a month-long trade. I think it was 35 days when they put it on. $1.4 million if the market doesn't go down 25%, which, I think that one of the biggest fear scenarios recently actually has been these volatility products hitting this inflection point where there's all these liquidations. It happened. We saw it. It was definitely a little bit freaky. The market quality at the end of the day on some of those really big down days was terrible. Right. All of a sudden, everybody remembered how hard it can be to trade options. Right. When all of a sudden, a market that's usually even Apple, we saw go from that thing trades in penny wide consistently. We saw spreads as wide as $1 on some options for 20 minutes at the end of the day. So, but that is something for traders to understand. This happens. How are you going to handle it? Because you can't assume that you can just get out for a couple pennies, even though most of the time you can't.
Right. So. All right. Well, thank you very much for joining us. And traders, thank you very much for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.